Delighted to be joined today by Scott Craig and Alan Glenn, and they're both partners at Azets, who are a great source of support for SCVO and for our members, because VAT and tax is complex, as I'm sure we'll all recognise. And Azets provide expert advice on VAT and tax to SCVO member organisations who have an income of up to £500,000. And they also provide that advice at a 50% discounted rate for our larger member organisations. So I'm going to hand over to Scott and Alan right now. I'm just going to get the slides up, if you bear with me. Right, share.
Thanks for doing this, Tracy. Technology and all that.
I know, isn't it great? Right, present. So I've got the thing at the top. Right, show beginning. So does that all look okay, Scott?
I think so. Yeah, that's good. We're all good now. Yes, thank you very much. Thank you, Tracy. Yes, so Alan and I were pleased to be here, delighted to be here. Nice to see you all. The purpose of the session really is to remind you or to highlight tax issues that are currently relevant for the sector, or regularly request or regularly asked via the helpline. We're hoping that at the end of this you'll have a bit of comfort that that what you're doing is okay, it's acceptable, and you're on top of your tax position. We're also hoping that you might get a few ideas or information that's going to help you to remove any tax risk or identify savings or efficiencies. And I think in the current climate, that's kind of what we're looking at, trying to make as many efficiencies and savings as we can make. The points that we'll discuss should be compatible with sector issues and pressures that we've heard of. So things like governance, things like funding, or dare I say the lack of it, staffing issues, and your own diversification, efficiency and growth plans. You know, we're kind of very conscious of all those, and VAT tax should all fit in with those. And being completely blunt, 9 times out of 10, VAT and tax are the last things that will be on your mind. So if this can jog your memory a little bit or put something on the list, then good stuff. With that in mind, what we'd like to kind of just show in the next slide is what we plan to talk about. So the plan is to try and, as I say, help you improve your tax position, focusing specifically on corporation tax and VAT. We're going to give you a gift aid refresher, because gift aid is a great source for those who can claim it of additional income. We want to talk about subsidiary companies and the need or otherwise for them. And we're going to finish off with capital projects, because we're aware that people are spending quite a lot of significant sums of money and getting funding to improve or to construct property, and VAT seems to be raising its ugly head as far as those issues are concerned, as far as those properties are concerned. We also want to talk about HMRC structured risk reviews. Alan, do you want to mention that?
I can cover that off, Scott. I've had a few clients involved in these already. So last year, HMRC announced that charities would get their own customer relationship manager, and HMRC would start a process of taking on these structured risk reviews. So they're quite detailed reviews. They're, as you'd imagine with HMRC, they're around tax, but they go actually a bit wider. So those are the kind of 4 pillars you'll see onto that slide. So they're actually looking at your operational and financial governance structure. So they look at how financial decisions are taken, how they're recorded, and how they're, I guess, followed up. They also look at where you're generating income from charitable activities. They look at how you're applying that for charitable purposes. So again, that's going a bit wider than what we normally expect from HMRC. They're keen to look at your gift aid processes and procedures, and Scott's going to cover that off in a minute. So that will definitely help you. And as you'd expect, they want to cover all the taxes: VAT, corporation tax, employment taxes. So in the end, it probably turns into a typical HMRC inspection, but it seems to be a bit more to it and a bit more structured and pointed. You know, since COVID, we haven't seen much of HMRC inspecting our clients, but this seems to be the start of something. So I think this session is coming at a good time.
And I think it fits in with, you know, the governance issues, the kind of the reporting, the outcomes, the performance issues that you as not-for-profit organisations have no doubt got yourself, either internally or reporting to your kind of your kind of funders or your members. So it's kind of part of the world that we live in, I think, these days, that, you know, people are held to account a little bit more. And I think, as you hear us say a few times, keeping evidence, documenting what you're doing is really important. You know, whether you think it's important or not, it is important from a tax point of view, because it can explain why you've done something or why you haven't. So with that in mind, kind of moving on to the next kind of or the first main section, improving your tax position. The first thing I'd like to talk about is corporation tax, which is on the next slide. So just a few kind of bullet points. Corporation tax, the main thing that seems to be coming out is use of a subsidiary and using gift aid to donate profits up to the charity. Now, the main reason for that is to minimise or remove any corporation tax hit or loss of income from corporation tax. There are other reasons for that, for having a subsidiary company, and I'm going to look at that in a separate part of this presentation a bit later on. I would probably say to you, just to put in your mind at the moment, the question I would have is, do you really need a subco? Because they do come with additional baggage, additional costs. Is it really necessary would be my kind of question, but we'll cover that in a minute. If you don't use a subsidiary company, remember that you've got a turnover, a kind of an acceptable business turnover limit of 80,000. And once you exceed that, you then need to start reporting and accounting for corporation tax. You still only account for corporation tax if you make profits. So again, we'll touch on that in a bit later on. But you know, whether you've got a subsidiary or not, corporation tax it's all going to manifest itself on profits. Within the kind of corporation tax band, I'm going to mention the sale of properties. Now, the sale of properties should be, and is normally from a capital gains point of view, exempt, as long as you use the money that the profits that you've generated or the gains that you've generated and invest it into charitable purpose or charitable purposes or charitable properties. So again, there should be a way of not having to pay any capital gains, but you've just got to be very careful that if you don't use it for charitable purposes, and people are diversifying quite a bit, you could get stung for capital gains tax. The other thing I'd flag up, and it's pretty specific, but if your sale agreement for the property includes a provision for future profits from a development, you know, for example, you sold land to a developer and you're going to get profits from the sale of those developments, then you need to think about the tax position, and there could be tax implications on that. I'm going to flag up R&D, so research and development expenditure. Now, whilst not normally applicable to charities, and you're not normally eligible for it, subcos, your trading subcos could be, so it's worth bearing in mind R&D for them. Capital allowances are available for charities, which again, not-for-profit organisations that perhaps have got trading, perhaps have got profits. You can use capital allowances and set those against profits to reduce any tax liability you may have. And the final one, for those in the cultural or the kind of heritage areas, museums, galleries, exhibition tax relief. It sounds like a tax relief. It sounds as if you should be paying tax, but actually it's payback. So if you're in the culture, arts, heritage sector and you've never heard of museums, galleries, exhibition relief, please let us know, contact us afterwards, because there is the opportunity to get money back. On average, about 30% of the costs that you incur could be repayable as a refund from HMRC. So that's kind of corporation tax. I think we're on to VAT now, Alan.
Yeah. Tracy, if you want to move us on, please. Great. Yeah, so I guess the question I always get asked is, I'm a charity, I can't recover VAT. How can I save VAT? And I guess the simple answer is, don't pay it. I don't mean don't pay your suppliers. I mean, look out for opportunities not to pay VAT, so expenses that don't carry VAT. So, for example, advertising is a very good one. it used to be that the advert must carry the charity's message, but of course that's not the case any longer. It applies to all adverts taken out by a charity in a third-party medium. So that can be, adverts in magazines, radio, television, newspapers, and that can include, promoting a charity event, promoting the charitable message, or just looking for new members of staff or board members. All advertising should qualify for 0 rating. You will normally be asked to provide the supplier with a certificate, but it's fairly straightforward. The next one is your fuel and power bills. So fuel and power is normally liable to standard rate VAT 20%. However, where it's used by a charity, either in small quantities or for non-business purposes, so where the charity services are seen as non-business, i.e. they're maybe funded by grants, they're free of charge to the service users, then you can qualify for the reduced rate of VAT. So that's 5%. Now that might apply to the whole bill if the energy meter is serving a building that's used wholly for those purposes. But if it's not, let's say it's an office that's used to administer lots of different activities where there is different liabilities from a VAT perspective, then the 5% on your bill can be prorated. So if you use half of your building for a drop-in centre where public are able to access your services free of charge, and the other half of the building is used to generate business income through trading, then you'd get 50% of your bill at 5% VAT and 50% at 20% VAT. So there's no prescribed method for performing that calculation. I know that someone has asked that question prior to the session. So if they want to reach out after this, I'd be happy to talk it through with them, because the calculation can be quite subjective. Should add there that climate change levy is applied to fuel and power bills that attract the 20% rate of VAT. So there's a double saving there. If you can get the fuel and power at 5% VAT, you also get an exemption from climate change levy, which will take your bills down even further. So I guess in these days where energy is such high cost, then it's definitely worth looking at if you're not already benefiting. The next one up is construction projects. I'm not going to go into that too much because I'm hoping you'll all stay on for the final session today, which is covering capital works. But safe to say that there are a few savings there. You can get 0 rating on construction of certain new buildings, and in some cases you might pay the reduced rate of that. Finally, the kind of the last saving is around if you're renting property. Property rental by commercial landlords is often subject to VAT. So if you're looking to rent property, it's worth looking out for properties where the landlord hasn't opted to tax the property, so they don't intend to charge VAT. That would obviously save you. But equally, there's a trump card that you can sometimes play where the landlords have opted to tax and are charging VAT on the rent. As long as you speak to them before you enter into the lease agreement, they might be prepared to accept your trump card, which says, we're a charity, we intend to use this building for charitable purposes, please do not charge us VAT. Now, it doesn't work in all cases, and often it's just a negotiation tool. Normally, landlords want to charge VAT on rents because it allows them to recover VAT on expenses. So if you play that trump card, that might not sit well with them. So all I would say is it's a weapon in your armory. It's not a silver bullet, but it's something to bear in mind if you're negotiating a let to new premises. So if we move on, Tracy, just to the I'm trying to move the slides myself. That'll work. Yeah. So I guess these are probably a summary of the key questions we're asked around VAT on the helpline that we offer to SCVO members that Tracy mentioned earlier. The VAT liability of income comes up probably the most common. I.e., do I need to charge VAT on a new income source, or I've heard it's exempt? Does it qualify for exemption? I think it's very difficult to cover the whole breadth of those in one session. What I would say though is, if you're in any doubt, just put a question into the to the helpline and get in touch, and we can talk through the principles with you. I suppose the greatest risk, as I see it, is that if you're applying an exemption, you need to be comfortable that the activities that you're undertaking fall within that exemption, because that's usually an area of challenge from HMRC. Usually when HMRC inspect, the first question they'll ask is, give me a list of all the income that you're not charging VAT on. I guess that's where they can see they can make some money if you're not getting it quite right. So I suppose you can ask yourself that question as well. What income streams are you not charging VAT on? And are you comfortable with that? And if you've got any questions, yeah, give us a shout. I never thought I'd have to bring this up either, but there's a special status out there for certain charities, but some aren't aware of it. And we've had the great fortune of telling some charities that actually, because of what they're doing, it's covered by a special status that HMRC have granted them. And that, despite the fact that they might not be accounting for VAT on their income, they can recover all the VAT on expenses. So if you're a museum, gallery, or you're providing air ambulance services or palliative care, there might be opportunities there. So again, reach out to us. One of the big issues we see quite often is, am I receiving grant funding, or am I receiving a payment for services? I guess don't be fooled by the word grant on a funding agreement. HMRC's guidance tells you that that really means nothing. It's a neutral factor in deciding whether you're receiving a grant or a payment for services. I guess the key is usually around, well, what are the circumstances in which the payment is being made? Are you applying for funding to deliver a project that you dreamt up? In which case that's typically a grant, and therefore you don't have to account for VAT on it, but you might not be able to recover the VAT on your expenses. So you have to think about how you budget when you're applying for the funding. Equally, if it's more of a case where the organisation giving out the funding has put out a call to action and is asking for people to submit bids for the funding, you might well be being asked to deliver services. So usually in that case, it's a payments by results. There's you're getting a level of payment depending on the level of service or goods that you provide. So something to watch out for. Next question up is usually, well, how can I improve the recovery of VAT on expenses? I guess it's the obvious one is generate more VATable income. So something we've seen others do is turning a grant maybe into a sponsorship arrangement. So normally a grant would be freely given. It doesn't help you with recovering VAT on associated expenses. But if you can deliver some services in return for that payment and turn it into some form of sponsorship or advertising agreement, then it might be possible to increase your VATable income at no cost to your customer if that customer is in business, and allow you to recover more VAT on expenses. VAT registration and deregistration probably get asked that question 5 times a day. Should I be registered, or indeed I want to register because I'm incurring a lot of VAT on expenses? The key point there is, to be able to register, you need to be making taxable supplies, and so that's supplies that are at either the 0, 5 or the 20% rate of VAT. If you think you're making supplies of that nature, then it's possible to register for VAT. If you're making supplies in excess of 90,000 in any 12-month period, then you don't have a choice. You will have to register. So if you think that applies, yeah, by all means get in touch and we can point you in the right direction. Similarly, we've got charities maybe have been registered for a while. They registered because they wanted to recover VAT on maybe a big lump of expenditure, and now want to deregister because actually it's an admin hassle and it's costing them money to keep that going. Just be careful around that. Where you've recovered VAT on assets, then you might have to pay some of the VAT back if you deregister. So don't jump into that before you've sought advice.
Just to add to what Alan was saying there, that if you're getting payments, you're receiving payments, you're not quite sure what the VAT position is, there's a kind of well-trodden path that we've kind of mentioned before in sessions, where if you're receiving consideration payment, even in-kind services, and you're making a supply in return, so as Alan said, you've either had to go through a procurement process or you're providing something specific and measurable back to the funder or the person who's providing you with the payment or the consideration, then you really need to think about the VAT position, because chances are it's liable to VAT. It may be exempt, it may be zero rated, but starting point is that it's liable to VAT if there's a consideration for a supply. I think the other 2 points, just picking up what Alan said, if you are registered, I'm guessing that your priority would be maximising VAT recovery, because you have to register, so you may as well get the best out of it you can. And if you're not VAT registered, you probably are looking for situations where you don't receive taxable income. So back to the grant funding idea, grants would be good because they're not VATable and they shouldn't result in any requirement to register. And if you're not VAT registered, please keep an eye on your registration limits. It's one of the areas that HMRC have got basically kind of unhindered powers. They can go back to an unfettered date to register you. They have to register you from the date that you exceeded. Even if it's beyond the normal 4-year rule, they can still register you. So make sure you keep an eye on registration, especially if you're not registered already. Okay, moving on. We're going to jump on and look at gift aid now. Now, gift aid is, in my mind, it's a welcome source of additional income for those organisations that can claim it and do claim it. And just to bore you with some stats in the background, in the last kind of census, if you want to call it, for gift aid, they reckon that 1.3 individuals, taxpayers, declared the donation on their self-assessment returns, and the claims that were being made have increased over the last 3 or 4 years by approximately 7% each year. So it's an area that the HMRC are paying out more on than they ever did before. They've paid out 1.7 billion in the year to April 25, and that's kind of increasing each year as years go on. Now, because it's an increasing cost of the government, it's got an increased attention from the government as well and from HMRC. So you definitely want to make claims and be aware of how you make the claims. But as Alan was suggesting earlier on, you must make sure that you comply with the rules. And it's still, gift aid is still relatively low key and a softly approach from HMRC. But I think it's one of those areas that you definitely expect them to sharpen their claws, for want of a better phrase, especially if they're kind of giving out more money than they would like to give out, because it's a drain on resources is the bottom line to it. So how does this work? So basically, gift aid can be applied on a payment that you receive from what they call a donor. It's effectively a donation of cash. And I know people talk about gift aid applying to admission charges and membership charges, and even on gift aid being applied where you donate goods to a charity shop. But the bottom line is, in the deep bowels of that mechanism, there's a donation for gift aid purposes. It has to be a donation from someone who pays UK tax, and you can't claim gift aid if the person hasn't paid UK tax or isn't a UK taxpayer. And if you can claim gift aid, it means that the donation that they give you, the financial contribution they give you, increases by 25%. So, in the classic example, if you get £80, you're going to get an extra 20. So that £100, that £100 mark is going to be met through a donation or a payment from the government. Now, you cannot claim gift aid where there's purchases of goods, and I'm going to come back to that in a minute. Admissions to events, raffle tickets, auction prizes, that sort of idea. Normally, you cannot claim gifted on those ideas. The donation of goods one, or the purchase of goods, is an interesting one because, I just said before, you donate all the bric-a-brac and the things you don't need anymore to a charity shop. They sell it for you, and they're then claiming gifted. But it's goods that are being sold. What's going on there? And if you kind of look at the small print, although you're donating goods, you're also agreeing that the charity can retain any cash that's been received from the payment or the sale of the goods. And it's that point, they've sold the goods on your behalf, they're getting to keep the cash, you're donating the cash to them, so that's why gift aid is appropriate and available. So back to that point, donation of cash. As we've talked about before, your government kind of systems work, that there has to be paperwork. So the paperwork you need, and all I would kind of suggest is that if you're going to be claiming gift aid, make sure you've got a clear audit trail from the point that someone has made the donation to the claim that you're making. Make sure that you can kind of trace it all the way through. Make sure you've got a clear and evidenced and retained gift aid declaration. It can be in writing, it can be email, it can be faxed, it can be text, it can be orally, by telephone. You just have to record that Mr. and Mrs. Snooks or Mr. Brown or Mrs. Jones has said that they're a taxpayer, they've got their address, and that they want to claim gift aid, or you to claim gift aid. The HMRC do provide models, pretty good models, to be perfectly honest, within the guidance that you can use. You're not obliged to use it, but why wouldn't you if it's there already? And I guess just in leading into this, as we said before, HMRC are inspecting, and there are a few situations where they've challenged and questioned the recovery or the claim for gift aid. It's normally where there's been really poor data, or there's been a lack of evidence to back up the claim. And the high profile ones, it's usually because they haven't retained records of individuals, or the individuals' names have been false, or the individuals signed a declaration when they were taxpayers. They then retired and they're no longer taxpayers. Hence, they shouldn't be claiming the tax or the gift aid. So you've got to keep your records and keep your information up to date. They also look out for overseas residents, because again, they don't necessarily pay UK tax, and look out for claiming gift aid on third-party online platforms. Again, you still need to keep the information, even if it's another platform that's retaining it for you or collecting it for you. Make sure you get that information. As I say, it's an area of increased government spend. So I would fully expect as the pennies become tighter for the government, they'll start kind of looking at this in a bit more detail. At the moment, it's probably VAT that they're concentrating their efforts on, but that will change as and when they need to look at other areas. Just kind of moving on from that. So if you do provide benefits to people, it doesn't mean that you cannot claim gift aid. So memberships are probably a really good example. If you've got a membership arrangement and you charge people membership, you can claim gift aid as long as the benefits that you provide are below certain limits. So if you look at, if your membership payment is, say, up to £100, then as long as the benefits that you're providing to the individual represent 25% or less of the donation, you can claim gift aid on the full amount. And even if there's VAT payable, you can still claim gift aid on the VAT element as well. Now, I guess what I would say from a valuation point of view, when you've got benefits, you should really value the benefits based on an open market value. So, for example, if you give someone the benefit of going to a performance or getting in to see something, it would normally be the open market value of the ticket that would be the benefit. If, however, there isn't a kind of an open market value, either you should be ignoring the benefit because there isn't. If the public can get in for nothing, then members should get in for nothing, and it's not a membership benefit. The flip side is that if the benefit is an event only for members and no one from the public can actually get into it, then you look at the costs that you incur and you base the benefit on the cost divided either by the number of invitations or the number of people attending. It does sound a little bit complicated. It can feel that way. All I would say is if you haven't looked at membership arrangements for a while, please review it, double check it. We're happy to help. We've done quite a lot of work in that area with a number of membership bodies, and we're feeling pretty confident, and we've been able to save people and identify that there's been kind of opportunities to get more money from gift aid for them. The last thing I'd probably mention on this is there are certain things that aren't seen as benefits, and it's kind of worth recognising those. Tracy, if you don't mind kind of going on to that, the next slide. So just basic acknowledgements, thank yous, are not seen as benefits. Admission to a charity property, if you give them at least a year's membership, or the gift is more than 10% of the normal admission price, normally you don't have to worry about that being a benefit. Naming rights aren't benefits. Newsletters, if they tell people what the charity or the not-for-profit body is doing, is not seen as a benefit. Any activities that are linked to charitable objectives, conservation work, that kind of idea, are not seen as benefits. Fundraising dinners, so if you've got a dinner for members as well as others, and it's a fundraising dinner and it's advertised as such, not a benefit. And the biggest one, which is quite an interesting one, is there's a sliding scale that, and there's a kind of a well-trodden path that the bigger the donation or the bigger the membership charge, chances are the less the individuals will want to get anything back. And we've got situations where kind of significant memberships or benefactor schemes, they don't give out any benefits whatsoever because the individuals are quite happy to give their money away and they don't really want anything in return. So if there's no expectation of a benefit and no benefits provided at sign up, then you can claim gift aid to your heart's content and you don't really have to worry about VAT either. So it's kind of, as I say, there's a few nuances there. There's a few things to just think about and bottom out, but please give us a call. Please let us know if you've got any questions. I'm happy to help. Moving on, I think we're okay for time-wise, aren't we?
Yeah,
moving on, another topical issue and another point that people ask us questions about, subsidiary companies. It seems to be that given the rising cost of administration and the complex and the complications between a subsidiary and its parent charity, people are asking the question, do we really need the subsidiary, I should say? There used to be a mindset that a subsidiary was just a thing you had to do. It protected charitable status, and Oscar, if you had any source of business income at all, Oscar might clamp down on you. Now, the reality is that Oscar haven't been clamping down on people that have got kind of business activities. Granted, they do issue warnings and they do ask questions where the business activities are significant and maybe significantly more than charitable activity, but they have always given a warning. They've never just taken the charitable status away, and there's always a chance to do something. So I think what I would say is, yes, it does protect charitable status without a doubt, but that's probably not the main reason that you want to have a subsidiary. Tax leakage. So if you have got business activities and you may have to pay corporation tax, that would be a reason that you might want to have a subsidiary company. And probably the biggest reason is risk. It'd be financial risk, reputational risk, legal risk, a kind of trustee risk, something that's going to pose a risk to the not-for-profit organisation. That's when you would probably, in my mind, want to have a subsidiary. And clearly, if your subsidiary's got certain purpose and certain activity and you're doing something out with that, then that would be a reason to think about subsidiary as well. So don't just take it as read, you must do it. I think the next slide is probably worth mentioning as well, that people often forget that from a corporation tax point of view, that there are activities which are automatically exempt as far as the not-for-profit or the charity is concerned. You know, they're listed there: bank interest, gift aid, dividends, quite obvious. One of the ones that people often forget about is land or property rental income. So as long as it's just a straight rental of property with no additional services provided in return, that's normally exempt from corporation tax straight away. So if you've got the thought of, we need a subsidiary company because we're going to be renting a property, probably not actually, and it's definitely worth looking at that situation and having a look at your arrangements, just in case, that you don't need the expense of the charity. Moving on, in a similar vein, the next question beyond what's exempt is, what is trading income as far as the charity is concerned? Now, things like, trading income that come from your primary purpose, so tickets to art exhibitions, charges for primary purpose activities, probably should still be exempt from any corporation tax. Ancillary trading, so if you've got a cafe or a bar or a shop, as long as that's not in kind of open competition, it's only really available to visitors or your participants, then I'd probably be saying that's probably still exempt from corporation tax as well. And a trade that's kind of carried out by beneficiaries, so a cafe run by disabled people by a disabled charity, or a kind of ex-service charity running it by ex-servicemen or whatever, that same idea, beneficiaries running it for a beneficial purpose. Again, I wouldn't be expecting you to see that as a source of trading income and subject to corporation tax. And even if you've got trading income, you're allowed to have certain values of it before you start paying corporation tax. And the value, I guess, the one that everybody falls under is your trading income over 320,000. You're allowed to have business or trading income up to £80,000. Sorry, turnover of over 320,000, trading income up to 80,000, and you're still not paying corporation tax. And even if you're above that, remember, you're only going to pay corporation tax if you make profits. And in a lot of cases, whilst you've got a good source of income, when you start looking at the costs and sending off the costs against that, your profitability might not be that high. So when you weigh up all of that, I would then say, once you've gone through that, I guess that filter or that funnel, if you still think that you're going to be making profits or there's a reason to have a subsidiary company, absolutely, then set up a subsidiary. When you've got your subsidiary, back to what I was saying before, the profits generated by the subsidiary, you can minimise the amount of tax, corporation tax that you pay on it. The next slide kind of shows that if you gift the profits that you generate in the trading subsidiary up to the charity, and you do that within 9 months of it after each year end, now you've got to physically pay it, and you've got to then leave sufficient reserves within the trading subsidiary to be able to continue trading, then you don't pay corporation tax on what you gifted up to the charity. Anything you retain in the subsidiary, any profits that are left in the subsidiary, you'd end up paying corporation tax at the appropriate level, the appropriate rates on. So again, what we're seeing in practice is organisations are seriously looking at the need to have a subsidiary company. They're looking at the extra costs involved. They're comparing that to if they didn't have the subsidiary, what would the risk for the charity be? What would the issue for the charity be? And ultimately, what could the savings or the cost be? So worth definitely having a think about and a discussion about. Finally, on this kind of idea, if you do have subsidiary company and you've got a purpose behind it, don't forget the points on this next slide, which are, if you'll have intra-group charges for staff, property and service costs. There needs to be appropriate charges at appropriate rates. They need to be justifiable and evidenced. If you're providing funding from the charity to the subsidiary, we've seen a lot of charity kind of cafes and shops needing to be subsidised. You need to do that on a kind of an arm's length basis. It needs to be a benefit to the charity. It can't just be kind of avoiding tax or kind of minimising tax. And you need to kind of think about, again, documenting and evidencing everything you're doing. Just beware as well that cost or that funding may be seen as non-charitable expenditure, and there's often a sting in the tail from a corporation tax point of view. You effectively reduce your trading, the £80,000 I mentioned before, can be reduced if you've got non-charitable expenditure, and that then results in the charity not having as much to play with as far as its trading activities are concerned. So it does sound quite complicated. I don't mean it to sound complicated. I just think the message is there's quite a bit to think about with subsidiaries these days. If you haven't reviewed the arrangements, or if you're considering it, look at it in a bit more detail, and we're happy to help wherever we can. If we could now move on to, you'd be sick of listening to my voice. Move on to Alan.
Yeah, good. Yeah, so despite the kind of difficult, I guess, financial position, trading conditions out there still seems to be a bit of public money available for community asset transfers from the public sector and the construction of new charitable buildings. So I guess this is a call, if you're involved in or planning a project, when you're thinking about who you need to employ, so the contractor is obviously the main one, and then there's an architect and there's a surveyor. I think given that VAT is potentially 20% of your budget, and usually quite a big budget, then I think it makes sense to add a VAT advisor to that list. Of course, I would say that. Of course, I would say that. But seriously, we have just unearthed one last week where they're spending potentially £2 million, so 400,000 of VAT. They have been recovering all VAT to date. HMRC hasn't challenged them. They've not picked it up yet, but because VAT is a self-assessing tax, and HMRC they won't challenge everyone, but from time to time they will inspect charities, businesses, and find out what they're doing and decide whether the VAT recovery was valid. So this particular charity has been recovering that just on the basis that it was VAT registered. And actually, based on its current plans, it's not going to be able to recover that VAT. So we're going to have to do a bit of pivoting to try and justify the position. But thankfully, they spoke to the SCVO helpline in good time that we should have the opportunity to do that. So a bit of a scary story, but there is some good stuff happening out there as well. So you can still build a new charitable building and not pay VAT on it. We've had a good few successes. The rules are fairly complicated, and because they're open to interpretation, we'd usually recommend seeking HMRC's agreement or approval, but it is possible. So if you're building what HMRC would term a relevant charitable purpose building, so that catches a lot of charities out. Charities will always say, well, everything we do is relevant charitable purpose. HMRC take a much narrower view, and it's back to the point that I was talking about with fuel and power bills. Relevant charitable purpose effectively means in HMRC language that you're delivering goods or services free of charge, so no charge. So it's limited when that zero rating might apply. What we're seeing though is that a better opportunity, and this doesn't sound like it might apply, but you'd be surprised. It's just because the VAT law hasn't really kept up with, I guess, everyday or up-to-date language. You talk about zero rating for relevant charitable purpose or buildings similar to a village hall. Now, I don't know when the last village hall was built. It seems to be a kind of Middle England thing but certainly all the charities I deal with around Scotland talk about their community hub or community centre, or so the terminology has moved on. But in essence, the buildings are probably carrying out a similar purpose to the old traditional village hall. And we've had quite a lot of success for community hubs being zero rated. So that's effectively, you don't pay VAT on the construction. And in one case, the charity was spending £6 or £7 million on this new community hub. That's over £1 million of VAT that was saved. So certainly, if you're looking at a project, just check whether zero rating might apply. There's also zero ratings for residential buildings, so that's either dwellings. So some community organisations do build dwellings where there's a shortage of social housing. Equally, might be a residential building, so you've got charities building, let's say, student accommodation or residential welfare type accommodation. Those might qualify for zero rating. But if they don't, then you kind of look at the next avenue as well. Could 5% apply? So 5% might apply, but it's usually only where you're doing work to existing residential buildings. So you're converting maybe a commercial building into residential, or you're changing the number of residential buildings or dwellings. So if that's the case, then you might be able to benefit from the 5% VAT. If not, then unfortunately you need to budget for 20% VAT, and that will always apply to any construction works that don't qualify for 0 or 5%, and all professional fees. So I guess if you're in that position, then the next question is, well, you're either going to have to fundraise to cover the VAT, or you're going to work out whether you can recover it. So in the next slide, we look at, well, how can you recover it? Recovery is always based on an intended use. And it's intended because obviously during the building period, you probably don't know exactly how you're going to use the building. So the recovery will be based on how you think you're going to use it. I'd always say, though, you need to be quite set and quite clear on how that will work and whether it will be sustainable. I guess if it's going to be used, if you're claiming zero rating, you're going to be having to certify to your contractor that you intend to use the building for, let's say, non-business purposes or similar to a village hall for a period, and that's typically for a period of 10 years. Because if you don't manage to continue to use the building for a 10-year period, then there's potential to have to pay back some of the VAT that you saved. Equally, if you're incurring VAT on the building works and recovering it on the basis of intended use, so you say, oh yeah, we're going to use the building for VATable purposes, we'll recover all the VAT. You'd be quite certain about that, because again, if you're spending more than currently £250,000, then you're going to have to monitor the use for 10 years. And if that use changes, you've potentially got to maybe pay a bit of the VAT back to HMRC. I should say that so that monitoring period for capital items is currently set at 250,000. There was a consultation last year that HMRC said that it'd be increased to 600,000. There's lots of rumours that it's going to be changed from the 1st of April, but there's nothing set in stone yet. But that would be good news. It would lift the ceiling a bit, meaning that you could spend up to 600,000 without having to worry about that 10-year monitoring period. So going back to recovering VAT, recovery of VAT will be based on making taxable supplies. So you then need to look at how you are using the building and whether those activities will be subject to VAT. And I guess in some cases you can turn something that might be exempt into a VATable supply. Now, what we've done for some recently is work out, well, is that worth it? So, for example, community organisations often want to construct buildings that they intend to rent out to the community. So ordinarily, unless you can argue that it's similar to a village hall, then they would have to, what we call, waive the exempt status of the building, opt to tax, and charge VAT on rents. Now, obviously, if they charge VAT on rents to members of the public or the community, that's a cost to the charity rather than to those who are renting, because they can't recover the VAT, so it's essentially income foregone for the charity. And what we've seen is, because those rates are normally quite nominal, then the VAT that you pay away to HMRC versus the VAT you could recover by charging VAT on the construction project can take many years to pay back. So very often it's worth opting to charge VAT on a very small amount, because actually it might take you, 30 years if you're recovering VAT on a multi-million-pound project to break even. So that's when you're renting it out. If you're using it for your own use, you need to think about, are we going to use it for free of charge non-business activities? Because in which case you probably aren't going to be able to recover all the VAT. Equally, if you're a welfare or education charity, like who does a lot of your activities are going to be exempt. So again, that would restrict you from recovering all of the VAT. You can't just, I guess, claim the money back from HMRC or tell the contractor not to charge you VAT. It's a case of you need to go through a process of registering for VAT, and that usually entails demonstrating to HMRC that you do intend to make VATable supplies, and then funding the cash flow of that VAT, which is important. That a lot of organisations that live hand to mouth forget to factor in that they need to be able to draw down the funding to pay the contractor the VAT, and effectively they might be out of pocket for 3 to 6 months before they can recover that VAT. And I guess the calculation of VAT for most charitable buildings, it's probably unlikely that you're going to be able to recover all the VAT. And I just say that because certainly all the projects I've looked at over the years, I'd say 99% of those where they're incurring VAT, they usually have to apply some form of apportionment to take account of free of charge or exempt activities.
We had one which is probably kind of the best financial model for these sorts of things just the other week, where the organisation wasn't VAT registered, so it couldn't recover VAT anyway, and it's looking for funding to cover all of the costs. So it's going to get 100% ideally funding. So it doesn't, it's not going to, the VAT shouldn't be an issue for it. It's going to get funding to cover all of that. But it knows, looking at its business plan over the next kind of 10 years, that it will be making VATable supplies that will require it to VAT register. So it's then at that point, at some point in the future, it can register and it can recover VAT that was previously not recovered. Now, the only issue with that one is that situation is, depending on the timing of that registration and recovery, they may have to go back to the grant funding organisations and explain, actually, we managed to get VAT recovery, and what do you want us to do with the funding? Certainly to date, all the funding agencies that we've been aware of have all just said, if it's, I say it's out the blue, but if it's something that's happened, 2 or 3 years down the line, they've never been interested in asking for the money back. So the fully funded model is probably one that has got less pressure from a VAT point of view on it. But if it's not fully funded, there's a model there we can help with.
Yeah, agreed. So there's a few practical considerations we'll just cover off here on the last slide. Conscious of time, 5 minutes to go. I've covered off most of these, but so planning permissions and restrictions. If you're looking to get zero rating on a building based on how you intend to use it, it's worth, I guess, thinking about VAT early and making sure that your planning permission supports in terms of the language you use, because we know that HMRC planning applications are obviously public documents, and we know that HMRC has access to the internet, as you'd expect. So you can very often see that maybe the practical use of a building isn't perhaps explained in a VAT-friendly way in the planning application. So just making sure that all your ducks are in a row before you apply for planning permission, especially if you're going to be relying on getting VAT 0 rating. Equally, as Scott said earlier, using a subsidiary might be an option. If the capital project might fail, then you might want to protect the charity by running it in the subsidiary. You then need to think about intercompany charges and I guess the flow of funding as well, because usually the charity will be receiving the funding for the work. So just working out how that might work in practice. We said that professional fees are liable to standard rate VAT. However, there is I guess an approved VAT planning arrangement which has been supported by HMRC in the past, which allows you to enter into a design and build arrangement. That's where either your own subsidiary or a third party contracts for the building works and the professional services and makes a single 0 rated supply. So that's only of benefit where the building, of course, would qualify for 0 rating or the reduced rate. But
on that one, I remember seeing a model that said that for a block of flats, there was about a £3,000 to £4,000 saving per flat on that sort of design and build model.
Yeah. I guess as we've kind of talked about, be careful if you're getting a VAT benefit on the basis of intended use. Make sure that it's sustainable, and if you know it's not going to be, then plan for that change of use, because there's potential clawback there. If you're incurred VAT and you're recovering it and it's on a capital item, again, currently £250,000 the threshold. It might go up to 600. Any projects above those levels where you've recovered VAT, you're going to have to monitor the use for 10 years. In our experience, mostly there's a payback to HMRC, but there can be good news in there if you recover VAT at a lower level early on, and actually the business activity takes off, and you can recover more as time goes on. So you get a little nibble at the VAT that you originally lost out on when you were calculating your recovery up front.
Anybody with projects which will be less than 600,000 over the next probably 12 months, give us a call, because there might be an opportunity to minimise your VAT hit or your VAT exposure.
Yeah. And I guess finally, just rents and options to tax anti-avoidance. If you're looking to rent your property to others, now that would be exempt, which doesn't really support VAT recovery. So in a lot of cases, you would want to opt to tax, so you could charge VAT. I guess there's points there you need to think about. How's the recipient going to feel about that? If it's another charity or a connected party that can't recover VAT, that might not work, or it might create an additional cost elsewhere when you're trying to make savings. Equally, if it is a capital item caught by the capital goods scheme and you're renting it to a connected party, and you or the connected party intend to use the building for any activities that wouldn't normally allow VAT recovery, you need to think VAT anti-avoidance provisions. Effectively means that although you've opted to tax a building, you still might not be allowed to recover VAT.
It's quite, as we try desperately not to kind of make things too geeky and techy, and not to disappear down too many VAT rabbit holes. And inevitably, when I listen to ourselves, we automatically fail, because it is quite techy, it's quite geeky. A big part of this is in the translation. So you know what you're going to do, you know what your activities are. We will know what the tax and the VAT implications are, and that's where the helpline helps to kind of get us together. And we're pretty comfortable that we'd hope to be able to kind of give you options and help you kind of work out the best opportunity. We just need you to reach out to us and use the helpline. That's all.
So if you've not used it, give it a try. And if you're not a member yet, become a member and give it a try.
And hopefully if you tried it, you liked it. If you didn't, give it another go. Come on. The big sale. Well, back to you, Tracy.
Thank you both, and thank you for promoting the SCVO member benefit. That's great. I'm going to stop sharing now. That was very comprehensive. Thank you.